Hi, good morning, everyone. Welcome to our Phillip Securities Research Weekly Morning Call. Today, we have technical analysis on a few stock counters, and we will also have a quick summary of our Singapore 2023 Equity Strategy event that took place last Saturday. So without further ado, I'll hand over my time to Zane to run through the technical analysis section. Thank you.
Thanks, Max. So, for the technical analysis section, the first one I'll be covering is the Straits Times Index. So for STI, this week we could see a possible continuation of the consolidation that we have seen since the middle of November last year. So the immediate resistance will likely be at the 3,310 to 3,330 area, which is a confluence of the resistance for two trend channels, the blue one and also the black one in the chart. As for the immediate support wise, is likely to be between 3,160 to 3,210 area, where is the range support level, as well as the previous neckline resistance at 3160, which was prior to the gap up that we saw in November last year. Next slide. For the S&P 500, there's possible continuation of a bullish momentum after the jobs report on Friday. So with that, we actually broke out of this consolidation triangle on Friday. So we could see we could possibly see the momentum continuing to reach the next resistance at 3,930 to 4,000 area, where is the 50 to 61.8% Fibonacci retracement levels when we use the swing high of 4,001 to the low at 3,760. Also, the 4,000 level also matches with the key downtrend resistance line that S&P saw resistance last year. For immediate support wise, it's likely to be at 3,765 to 3,800 area, which is the triangle support area that has held it since December last year. Next slide. For individual stocks, the first one is Wilmar International. So for Wilmar, its potential technical sell at $4.06, take profit at $3.85 and $3.75. The stop loss at $4.15. The stop loss closed at $4.14 on Friday. So for Wilmar, there is a potential breakdown of this consolidation triangle to retest the support zones at 385 to 395, as well as 363 to 375. So the price actually failed to sustain above $4.17, the horizontal resistance level that it broke out of, and actually pulled back after it hit the 61.8% Fibonacci retracement level at $4.23, when we reached a swing high of $4.71 and swing low of $3.46. Also, the MECD indicator also displaying a weak momentum, as it has made a lower high while price actually made a higher high during this period, which is a bearish divergence signal. So with that, the price could retest the first support zone at 385 to 395 first, where the 385 level is confluent with a 50% retracement level before it hits to the next support zone at 363 to 375, where the 375 level is confluent with a 61.8% Fibonacci retracement levels. When we use a swing high of $4.24 and $3.46 as points of reference. Next slide. So the other counter would be Mapletree Pan Asia Commercial Trust. So for this, we have a technical buy at $1.68, the take profit at $1.78. The stop loss can be placed at $1.64. The stop loss closed at $1.69 on Friday. So for this, there's a potential follow through of the bullish momentum to retest the horizontal neckline resistance at $1.78. This given that actually the price broke out of this bullish cup and handle formation after it broke out of a downtrend channel previously. So these are signs of bullish signals. So also the MECD indicator registered a bullish crossover recently, and with the momentum increasing, we could see it retest this 178 level. So that's all from me for the technical analysis section. I'll now pass on my time to Paul to give us a summary of our 2023 equity strategy for Singapore.
Yeah, thanks, Thanks, Zain. So we'll move on to our Singapore equity strategy. As usual, after every event, we will just give a summary on the following Monday. So our strategy is basically we are positioning for disinflation. We think inflation will come down faster than expected. And as we saw last Friday, any signs of inflation softening better than expected can actually trigger a rally in the equity markets. But having said that, we do throw a bit of caution for at least the US markets. It's just that with global growth still slowing down, the upside we think is going to be a bit more range bound rather than any new highs and so forth. But as the picture depicts, we think there's goods, rents, money supply is all coming down, and this will be positive. The short-term rally will be maybe the Fed would be hiking only 25 basis points for the next two meetings. Next slide. Okay, so anyway, just for some macro summary, so we think goods inflation is of course coming off. Then we also have money supply coming off, and we also have energy prices all coming off. So now we think the next should be services, which has been very stubborn. So if you look at the red line, when we always see the CPI headline numbers coming up from the US, the part that keeps on rising or at least doesn't drop is services. Most of it is shelter and mainly rent. So we think with the sharp decline in rents from the US, we think the stubborn services index will also start to decline, and this should push inflation numbers further down. Next slide. The other thing is transport costs is probably one of the easiest measure of the decline in rates. So you can see the container rates is this is basically shipment from the China to US and Europe, and that's down to almost pre-pandemic levels. Next slide. So in terms of the recession fear, so even if there is a recession, we think it will be modest. So one of the reasons is if you look at the table on the left, this is basically nominal GDP. So this is the actual GDP. You can just think of it like cash flows in the economy. So during the global financial crisis, those recessions were really severe. On even this should also be shaded. Even the 2020 recession, you can see that there's a sharp decline in nominal GDP. But we think when we move to 2023 and 24, any decline would not be as bad. It will be back to almost like 2011, 2014 types of GDP growth in terms of nominal. So this will soften the blow. Of course, the strong labor will also soften the flow. The definition of inflation is not just GDP, but it also includes a softening, sharply slower unemployment rates and labor, which is not happening in the US. The other thing is that, of course, more important as equity market is the decline in earnings. So if you look on the right, this is how much US earnings declined during a recession. So you can see that the market is fearful, obviously, because the last three recessions, earnings can decline like 20 to 23%. Oh, sorry, 15 to 23%. But when we have inflationary periods, actually the decline in earnings isn't that severe. So we think even if there is a recession, the impact on earnings also will not be that severe because we are in a bit more of an inflationary period. Next slide. So in terms of Singapore economy, the Singapore economy is extremely robust. So you look at wage growth. So wage growth is one of the best we've seen in 15 years. So this is contributions by CPF. Next slide. The other positive is there's ample jobs. Of course, if you look at the blue line and also the red line, these are the total vacancies available. The orange line is basically unemployment. That means the number of jobs available. Pre-pandemic, there was like one job available for every one person looking for a job. But right now, there's two jobs available for every one person looking for a job. Next slide. Of course, net assets is also building up for most Singapore households. This is compiled by Department of Stats. So property was up 13%, overall up 7%. I think cash is also up like 4 to 5%. So this is how the Department of Stats measure. Yeah. Next slide. Even then, the other positive for Singapore is, of course, foreign direct investment. So FDI is back to like almost 100 billion a year. With the reopening in China, hopefully this can actually perk up a little bit more. As you can see that Singapore, the inflow of foreign investments into Singapore is more than all the 5 ASEAN countries combined, which is Indonesia, Malaysia, Thailand, Philippines, Vietnam. The next slide. Valuations in Singapore are still attractive. If you look at the PE, so the PE is at the lower quartile, and I mean, valuations tend to expand. Of course, this is a slightly different environment, but valuations, whenever hit the lower bottom quartile, they tend to expand. So if that happens, then they'll be positive for the market, especially if interest rates are coming down. Next slide. Just one last part. The other positive will be the reopening of China. So we estimate around 3/4 of all the STI component stocks. Of course, not every stock is on the SGX, but the main ones will have some tailwind or some benefit from the reopening of China. The ones that least benefit will be the REITs, but those will be through indirectly, maybe through tourism for the malls and so forth. So if you run roughly line by line, like banks, Glenn will mention later, the banks will have benefit because of their loans and property. Then for Wilmar will be their branded oil they sell, soil meal crush they sell to swine. Then of course we have the dairy farm or DFI through their grocery, and also Emperador that sells a lot of whiskey in China. So all these, of course, likewise, I won't run through everything. Even roaming will be good because China is not the second largest destination. So many sectors in Singapore will benefit from a reopening or return to growth for China. Next slide. For in terms of sector trends, I'll hand it over to Glenn on the banking sector.
Yeah, thanks, Paul. So for the banking sector, I'll just start off first with a quick recap of the 2022. So the interest rate hikes resulted in large spikes in the NIMs and the net interest margin, the NIMs, and the net interest income, the NII for the banks. So the Fed rate hikes in 2022 were the highest on record, with the hikes totaling around 425 basis points, and resulted in a similar move in our Singapore interest rates, mainly the 3-month SORA and 3-month SIBOR. It increased to 2.69%, which was up 253 basis points year on year, and the SIBOR went up to 3.99%, which is up 355 basis points year on year. So based on historical data, we can see that there is a strong correlation between the US Fed's funds rate and both the SORA and SIBOR. So the Fed funds rates goes up, the Singapore interest rates are also expected to increase in tandem. And as a result of this Fed rate hike, as well as the subsequent increase in the Singapore interest rates, the bank's NIMs increased by 44 basis points from 1.53% in the first quarter of 2022 to 1.97% in the third quarter. And this is seen in the chart here. While the net interest income in third quarter surged by 42% year on year. However, these higher NIMs were offset by the moderating loan and deposit volumes, as well as the lower fee and other non-interest income. And this was mainly due to the weaker market sentiment, as the customer activities were more subdued amid a risk-off investment sentiment globally. So the decline in fee income was mainly seen in the wealth management as well as investment banking segments. But this was offset slightly by an increase in credit card fees as borders started to reopen and increase spending, as well as an increase in the loan-related fees. So for comparison, if you look at this chart, the pre-COVID NIM growth was quite stagnant. So if you look at 2019, for the same period, NIM was flat and the net interest income only grew 6%, while year on year, while in 2018, NIM only grew 2 basis points and the net interest income grew 13% year on year. Now moving on to the next slide. So for our outlook for 2023, we'll be looking at the loans growth. So we have plotted this graph here with the 3 different segments as well as total loans growth. So mainly financial institutions, housing loans, building and constructions, as well as total loans. So amongst these various loan segments, over the past 4.5 years, the financial institution segment was the fastest growing. And we believe that bulk of these loans were for commercial property acquisitions, especially for the REITs. The 3 local banks' combined loans to the FI segment grew by 25% in 2021, resulting in a sharp spike here you can see in the red line. And it grew at a CAGR of 7.7% over the past 3 years. This actually outpaces the total loans CAGR of 4.3%. So total loans line would be the dark blue line there. So for comparison, the housing loan segment only grew at a CAGR of 1.2% over the past 3 years, while the building and construction segment grew at a higher CAGR of 7.9%. So the housing and loan segment is the second largest loan segment, while the building and construction segment is the largest loan segment, making up 27% of FY21 total loans. So with Singapore loans growth ranging from 2 to 5% over the past few years, and with limited areas to grow in Singapore, we expect that the segment with the most potential would be the FI segment, with loans mainly to the REITs. However, as it has the most potential, there's also the largest stress is also possible from this FI segment, as it was the fastest growth category. So anecdotally, we do observe stress in the commercial property loans to listed companies with exposure in emerging countries such as China, Malaysia, and Myanmar. So if you look at the first half figures, while there was a dip in the growth based on these figures, the FI segment still remains as the segment with the highest growth. So that's all I have for the banking sector. I'll now hand it over to Darren for the REITs.
Thanks, Glenn. Yeah, so for the REITs, 2022 was quite a bad year for them, mainly because of the spike in interest rates. The Fed rates are heading to 5%. So this really made all the REITs have a sell down. So for the subsector performances, hospitality sector was the only sector that came in positive at about 5%, while commercial was the worst performing sector in 2022 that was down about 24%. So from what you can see from this graph is this is actually the S-REIT, the yield spread over the 10-year Singapore government savings bond. So this is like a proxy to the dividend yield minus like a risk-free rate, a risk-free bond. So you can see right now it's trading at around the negative 1.6 standard deviation, which means it's very expensive. But this is trading so low mainly because of the rise in bond yield rather than the decrease in yield, the dividend yield for the REITs. So going forward in 2023, there are some headwinds. One of it is because interest rates are high, inorganic growth is still a challenge as what was seen in 2022. So it's a similar situation going forward. But in 2022, there were some acquisitions in Japan, mainly because their interest is still cheap. Their interest is still around minus 1% as compared to the rest of the world who is really all raising interest rates. And then another headwind is the property devaluation. As of the end of 2022, Manulife REIT, they issued a note that their property asset value will decrease by 10.9%, and that will bring their gearing to 49%, and their ICR also will be affected to, can't remember the figure, but 2.9, like close to 2.5%. So this devaluation was mainly because of one asset in Figura, because of their operational capabilities going forward. Like the occupancy might be affected because some of the tenants are leaving, and of course the increase in discount rate and the exit cap rates. So we believe this will affect the other REITs as well, the increase in discount rate and exit cap rates, but it will not affect them as much as Manulife REIT, as the devaluation mainly came from the Figura I mentioned earlier, mainly because of the operational the effect. Yeah, so next slide, please. So just saw that slide is the whole index dividend yield spread. This slide shows more individual stocks against the dividend yield spread. In blue is CLAS. CLAS is the new ticker for CapitaLand Escort, and CLAR is the new ticker for CapitaLand Ascendas REIT. So over here, there's Capital DC, CICT, Fraser Centrepoint, and Fraser Logistics and Commercial Trust. So as you can see, the orange line is Prime. Prime US REIT, the dividend yield spread has shot up in comparison to the other REITs who are trading around 2 to 3%, the dividend yield spread. So this shows that Prime has already priced in a lot of the risk going forward. While the Singapore side, that the red box there is still trading around 2 to 3%. So it's not really priced in any risk going forward. Yeah, next slide, please. This slide is the S-REIT price index versus the 10-2 year bond, US and both Singapore and US. The US 10-2 is in orange, and the Singapore bond 10-2 is in gray. So as you can see in the red box, there is a slight negative correlation. It is more prominent in this red box, but you can see it from December 10 to December 15 as well, there is a slight negative correlation. So if we believe that this negative correlation will remain going forward, now that the yield spread has narrowed and actually inverted, we believe that there might be a chance that the S-REIT price index might stage a recovery. Next. So this chart is the scatter plot of more than half of the REIT index. How you read this is actually the bottom right is cheap valuations, while the top left is expensive valuations. So you can see there are a lot of the Singapore listed REITs are scattered around the 0.7 to 1 price to book and 4 to 6% dividend yield. And the overseas REITs are trading much cheaper in comparison to the Singapore REITs. Like you see Prime and US are trading at about 0.5 times and at 17% dividend yield, while Cromwell is at 0.5, also double-digit dividend yield, Elite also. And as usual, Parkway Life REIT is still around 1.6 times book and trading around 4% dividend yield. So that is the expensive side, and the overseas side are the cheap side for valuations. Next slide. And for S-REIT subsector preferences, we prefer the hospitality sector, mainly because of China's reopening. And right now, as you can see in this chart, the RevPAR numbers are already 20% above pre-COVID levels. And while the visitor arrivals are still 45% below the pre-COVID levels. So when the visitor arrivals start to creep up with the reopening of China and more international tourism, we believe this RevPAR will continue its upward trajectory. So that's all for REITs. I'll hand over the time to Terence.
Yep, thanks, Darren. Good morning, everyone. For the construction sector, we still remain bullish on the construction sector, but we are cautious in the up to the first quarter of 2023, mainly because of the heightened alert that is in place. So just to rewind a little bit, the heightened alert was actually imposed by the Ministry of Manpower or MOM on the 1st of September. Stretching for a 6 months period in view of the high number of fatality cases in the construction sector. So the heightened alert is put in place to ensure that the construction players observe a period of safety timeout during this period, and they need to ensure that they comply with these rules. So the implication is that if they do not comply with these rules, then they will see suspension of their work progress in certain cases for a week, extending up to a month. So that will have an overall impact in terms of the progress of the construction jobs completion. So for that, we are a bit cautious. You can see for the first 10 months of 2022, the construction contracts awarded, it is this chart here on your left-hand side. The construction contracts awarded is this blue line here. You can see that for the first 10 months of 2022, it's already down 9.4% on a year-on-year basis. So we expect this to persist until the first quarter of 2023. But having said that, we expect for the full year 2023 and beyond to actually continue to see demand remain healthy, and that is the result of the construction backlog and the slate of BTO projects that have been announced by HDB. So if you look at this table, in 2022, the BCA already upgraded their forecast previously from 27 to 32 billion in this table here to 29 to 32 billion. And for 23 to 2025, they expect construction demand to hold up and remain resilient to see 27 to 32 billion. So with that in mind, we remain overweight on the construction sector. In our next slide, in terms of the utility sector, so spark spreads, even though spark spreads corrected in the second half of 2022, but this remained elevated for the third quarter, and even in the fourth quarter of 2022, we see spark spreads actually recovering. So just to recap what spark spreads is. Spark spreads is really the difference between the USEP prices, which is the Uniform Singapore Electricity prices, which is the price that we pay for electricity, and then you take out the high sulfur fuel oil oil, which is the cost, or HSFO, the cost, and then you get the spark spread. So spark spread is really the difference between the price that we pay and the cost, and which is the profit, is a proxy profit for the GenCos generating electricity. So if you look at this chart here below, you can see in even the third quarter of 2021, you already see a spike in the spark spreads, and this spike in 2021 was driven by a spike in energy demand in the third quarter of 2021, and also because of the Ukraine war, the spark spreads actually remain very high up till the first quarter of 2022. Of course, it corrected in the second half of 2022 because of recessionary fears and the rate hike fears. But we can see the spark spreads recovering in the third quarter and even fourth quarter of 2022. So overall, we are positive on the GenCos, and we remain overweight on the utility sector. In my last slide on the air transport industry, we believe for the air transport industry, the easing COVID restrictions in China is a major tailwind for 2023. It will likely be the story for 2023 to support the overall growth in the sector. If we look at the latest month available in terms of data, November is already at 75% of pre-COVID levels. And when we look at the most latest data that we have, for first week of December, the passenger traffic is already at 82% of pre-COVID levels. The air transport companies are also bullish on the return of traffic. They expect themselves to break even by the end of the financial year and actually to turn profitable by the next financial year. Recall that their financial
Is there an issue with Terrence's audio? Max, can you hear the audio? Is there any audio?
No, I cannot hear as well.
Yeah, can you reply? Yeah.
I think Terrence has a connection issue. He just dropped off.
Yeah, so yeah, sorry everyone, just give us a minute. Never mind, I think we just continue next page. Yeah. Oh, wait, he's back. Yeah, let Terrence continue. Go back previous one for Terrence to continue.
Oh, so sorry, I just dropped off the connection. Yeah, so I'm not sure where I dropped off, so I'll probably just talk about the last few lines. Yeah, so overall we are positive on the air transport sector, mainly because of the easing China COVID restrictions for the sector, which we believe will remain a tailwind for the air transport industry for the whole of 2023. Yeah, so that's all from me. I'll hand over the time back to Paul.
Oh, thanks, Terrence. Next slide. So we move on to land transport. So what we see is volumes are still expanding. So what we see, the table on the left is basically rail traffic. So rail traffic is up. This is SBS Pacific. SBS transit traffic is up 50% year on year, 55% year on year. And also they are going to enjoy a price increase for all the rail operators will enjoy a price increase. Out of the roughly 14%, 3% will be from passengers, and the balance will come from the government subsidy. I wouldn't say subsidy, government subsidy. The one on the right is P2P, basically taxi and ride-hailing Grab traffic. So when you look on the blue line, so this is street hail, basically taxi, those who sit on street hail, that is coming down. That's down 14%. For ride-hailing, that's still very strong. That's up 16%. So for us, this is also important because that's the reason why Comfort has changed part of the way they collect revenue from taxi, is that to shift more of it now towards commission-based. Of course, there's good and bad to it. I mean, of course, rental is the best. You don't share passenger risk, but in view of most of the volumes now coming through from ride-hailing, the 16% growth, this is also a positive. I think the commissions they charge is around 5% compared to 20% for the rest. Next slide. We move on to for property. I won't run through this. The property cycle that has happened. Post GFC there's a rally, then TDSR, the market consolidated for almost 4 years, or declined for 4 years to be specific. Then 2018 there was a bit of relaxation. Then we had a few rounds of rally. So for our expectations, for 2023 will be another strong price rally. But we don't think it will be as strong as the last 8 quarters, mainly because there's going to be new supply coming up. Last year there was about 2022 there was about 4,000 new launches. So 2023 there should be around 11,000 roughly, depending on the timing. But it will still be, the demand should still be healthy because firstly there's a lack of supply. In terms of the whole market, inventory is 1.5 years compared to the 3 years average. Specific to the mass market is only 6 months of inventory. Yet the more important one that's driving demand is of course the strong basically the strong domestic economy, but also because there's a strong resale market because of HDB grants, and also the HDB resale market, which will generate equity for upgraders. The only thing that a bit more worrying, I'm not saying worrying, but the thing is now that that will put a bit of dampening effect will be the jump in BTO units. So if that increase, then those who wanted to upgrade will still wait for BTO, which of course is still going to be long, maybe 4 to 5 years. But the increase in supply of BTO will have at least some dampening effect on upgraders. But in general, it still be strong. Actually, our worry, at least what the industry worries more, is about whether the price is too fast. If the price crossed 10%, then they're worried there'll be another round of cooling measures. The best is if prices just rise 8 to 9% max, then at least it will remove the risk of cooling measures by the authorities. Next slide. For healthcare, just an update. We still have a buy on Raffles Medical, but just to give you a flavor what's happening in the healthcare. So this is IHH, the Malaysian listed, which is your Parkway Gleneagles. So what has happened is that you will see the red bar jumping up. So this is because the patient revenue per inpatient, that means every patient that go hospital, the inpatient the treatment has jumped almost 40% to 48,000 per patient. This is ringgit, not Sing dollar, thankfully. But the volumes are going sideways. But this is up because there are more medical tourists coming into Singapore, and also there are more elective surgeries by local patients. So that is what's happening, the growth in revenue for the Singapore hospitals. Next slide. So for semiconductor, the most recent cycle is up almost 32 months, one of the longest. We are undergoing a down cycle now, so the downturn could range 12 to 28 months. Our guess is probably by end of 2023. It takes probably the downturn will probably happen until end 2023. I mean, that's our own guess, I guess. Next. So some of the reasons is because the end demand, especially on the consumer front, has been weakening. So you look at PC. This is the table on your left. So you look at a PC, which is your desktop, handphone, tablets. Your desktop, laptop, and also your tablets. So demand was very strong during the pandemic. So obviously it pulled forward a lot of demand. Then it jumped 20% in 2020, 21, 26. Then now it's down 17. So it's giving back most of the gains. So those who bought, I guess, not buying anymore. So this has been a drag, and the other is also smartphones where they put bump. So you see the growth, but smartphones, they are talking about 1.3 billion units. But again, they're expected to decline for the next 2 years. The other thing that's happening is that semiconductor equipment sales is also weak because this is foundry capex. So this is what Samsung, Intel are spending on the wafer fabs. I know, like last time you chartered semicon. So that is, of course, very good for UMS and AEM customers like Applied Materials and Intel. But right now, they are cutting back. You can see from 2020 to 2022, during the pandemic years, there was a huge jump because of semiconductor shortages. But right now, what is pulling back demand is memory. So all the memory makers are cutting back a lot of their capex because prices are down. The other thing is also because of the inability to sell to China, so that has affected a lot of equipment makers. I mean, it ranges a few 100 million to some 1 to 2 billion. So So that is also another dampening. So you probably take some time to kind of iron out the effect of this decline from 133 to 117 in foundry capex, our proxy. Next slide. So for telcos, 2023 will be the recovery in prices of postpaid ARPU, because it collapsed from 40 to almost the low of 29, mainly because of the reduction in roaming travel. So roaming is normally 20% of ARPU or selling price. So this should recover, but the caution is just that it should help StarHub, but because StarHub is spending 300 million on a major restructuring exercise, so this is going to dampen their earnings for until early 2024. This is a lot of it is IT spending. They're going to revamp their whole IT infrastructure, and also on some of this EPL content. So that's why we have like a neutral because of StarHub. Yeah. Next slide. We only have accumulated because of valuations. For oil and gas, this is my last slide. Terence can comment more, but if you look at the blue line, you notice there's a big jump in order books. So the order books for Sembcorp, Marine, and Keppel Corp combined jumped 3 times from 6.4 billion to 18 billion. I guess this is one of the reasons why Sembcorp Marine did so well. Because one of the reasons is also because you can see the red line. So this is oil and gas capex. Of course, this is excluding Saudi Aramco, but this one you can see that from 126, there's almost a 30+% jump in capex to 176 billion by all the oil majors. Again, it's still nowhere near the 2013, 2014, but it's still a big jump. For 2023, you're still looking at about 11% growth in capex. So this should allow the order books for Keppel and Sembcorp to grow, but of course it won't be tripling, but they should have some growth in 2023. Next slide. Next slide. So this is our model portfolio. We try to only limit to one change a quarter to make it so volatile. So we took out Singtel. We still have an accumulated rating, but we just have a preference now. We're taking a bit more risk here, so we're taking on prime US REIT as our model portfolio. In terms of the performance, we were down about 0.5% in 2022. We were hurt mainly a lot by the mid-cap names like HR, Net, Del Monte. These are the ones that pulled down, and of course, Comfort. Next slide. So this is the performance. So we were down compared to the STI about 4.1%. Next slide. I'll move on to Glenn for the banks.
Yep, thanks, Paul. So just looking at the bank's data, look at the first bar right here, first red box right here on the top, we can see that the NIMs and net interest income growth was quite spectacular for the third quarter of 2022. And anyway, out of the 3 banks, we prefer DBS and OCBC. And we prefer DBS, it was mainly due to their high CASA ratio of 60%. So they're the bottom red box here. It's 60.3%. And this is the highest amongst the 3 local banks. So compared to OCBC at 56 and UOB at 50. So what this means with a high CASA ratio, the positive impact from the rising interest rates will be most felt by DBS. And this would translate directly into their net interest margins, net interest income, as well as their PATMI. And this BS business momentum is also strong. And despite the economic uncertainties from macroeconomic factors such as slower growth, higher inflation, as well as supply chain disruptions, their loans and transaction pipelines are expected to be strong. And management has also said that stress tests of their vulnerable sectors and countries have revealed no current imminent areas of concern. As such, we maintain a buy on DBS with an unchanged target price of $41.60. We also prefer OCBC, and it's mainly due to the upside of 21% to our target price of $14.22. Furthermore, OCBC is also currently still trading the cheapest amongst the 3 local banks. They will also be a beneficiary of the rising interest rates with a CASA ratio of 56%. This is higher than UOB's 50% and comparable to DBS's CASA ratio of 60%. There's also potential for higher dividends from OCBC due to its higher CET1 ratio of 14.4%. And you look at the one above the CASA ratio, that the row. So it is the highest amongst the 3 local banks. It's higher than DBS at 13.8% and UOB at 12.8%. So as such, we maintain a buy on OCBC with an unchanged target price of $14.22. So lastly, regarding the banks, I'd like to touch upon the China exposure. So if you look at the last row here, you can see the bank's China exposure, and it remains small at less than 10% of total exposure. So DBS reported 14% or 62 billion, while OCBC has 11% or 34 billion, and UOB has 5% or 23 billion. So the majority of these customers include mainly domestic and policy banks, top-tier state-owned entities, as well as large local corporates and foreign investment enterprises. And the bank's exposure to corporate real estate loans in China remains minimal. So one of the main reasons for the recent increase in UOB's share price in the fourth quarter of 2022 might be that they had the lowest exposure to China at 5% of total loans. However, moving forward, and with the recent opening of China, DBS's and OCBC's higher exposure to China might actually pay off, and they should be able to add to their growth moving into the rest of 2023. So moving next to the next slide on SGX. So for SGX, there are three main points we'd like to bring up. So the first one would be their volumes. So look at these two charts here. On the left, it shows their security daily average volume, and you can see that their securities volume is trending downwards, with the first half FY23 securities daily average volume, or SDAV, down 8%. And this is mainly due to the market sentiments remaining subdued due to the macroeconomic factors, as well as their volumes moderating from a record year in FY22. However, you look at the right chart here, their derivatives volume is trending upwards, with the first half FY23 derivatives daily average volume, or DDAV in short, was up 11.2% year on year. And as the market volatility continues to rise, the derivatives volume can climb for the rest of FY23. Secondly, we also expect the treasury income to rise in FY23. The treasury income actually dipped in FY21 and FY22, and this was mainly due to the low interest rate environment. However, we do expect a rebound in treasury income in FY23 by at least 8%. And based on historical data, the SGX's treasury income lags behind the Fed funds rate. And this is due to the majority of their collateral balances, which is 13.9 billion Sing dollars in FY22, being placed in fixed deposits with the tenure spread out. Hence, certain deposits have not matured yet and the interest rates have not been refreshed. So nonetheless, moving into FY23, we should expect the treasury income to recover to pre-pandemic levels as they get placed into higher interest fixed deposits. So for some context, in FY20, this was pre-COVID, the SGX earned a yield of 98 basis points on collateral balances when the Fed fund rate peaked at 2.5%. So the last point would be their derivatives pricing, and it's shown to be reaching new highs, with their equity, currency, and commodities derivatives average clearing fee per contract reaching a new high of $1.62 in the first quarter of FY23. And this is 12% higher year on year and 7% higher than FY22's average clearing fee of $1.51. This uptick in derivatives pricing is mainly due to the product mix of the derivatives being traded. This is quite encouraging, and we should actually see the derivatives fee continue to trend upwards. However, their securities average clearing fee per contract of 2.58 basis points in the first quarter was only marginally higher than FY22's average clearing fee of 2.56 basis points. And we should also expect this to maintain at these levels going into FY23. So overall, while the DDAV increase was slightly offset by the SDAV decline, resulting in a rather flat growth in volume, we believe that the derivatives pricing increase, as well as their treasury income recovery, will be able to boost SGX's growth and bottom line. We maintain a buy on SGX with an unchanged target price of $11.71. So that's all I have for the banking sector. I'll now hand it over to Darren.
Thanks, Glenn. Yeah, for CapitaLand Escort Trust, we like them because we see them for CapitaLand Escort Trust, we like them because of the recovery in China. The reopening of China will help to boost portfolio RevPAR further. As you can see, the year-on-year increase for portfolio RevPAR in third quarter 22 is actually up from 70 to 132 Singapore dollars. So that is almost a 100% increase in portfolio RevPAR. And then another reason why we like Ascott is because of their income breakdown. 56% of their gross profit is from stable income sources like master leases and the management contracts from minimum guaranteed income, and their longer stay properties. So Ascott also they have indicated that they would like to increase their longer stay properties percentage to about 25 to 30%. So this stable income part will help to tide them through any recession, if there would be any recessionary concerns going forward, while the 44% growth income that they had in third quarter 22 would help to the 44% growth income, they'll benefit from the reopening of China, because that will be a leg up of growth for them, as historically about over 10% of the international tourists are from China. So with that, we have a cumulative rating on Ascott, a CapitaLand Ascott Trust with a target price of $1.13, and they have a DPU yield of about 5.4%. Yeah, next please. Yeah, so for Prime US REIT, we like them mainly because of valuations. They are trading at 0.45 times price to book, so that is very cheap. It's at paying 45 cents on the dollar. And contrary to popular all the news that you see online, actually Prime's leasing momentum has been strong. So in the previous quarter, the third quarter, their leasing volumes were almost the first half leasing volumes combined. So third quarter is equivalent to the first and second quarter combined, roughly. So another reason we like Prime is because of their tenant sector diversification. They have 73% of their tenants in established and growth sectors, and their highest tenant sector is from finance. We also like them because of their high interest rate exposure. Their 83% either of their debt is either on fixed rates or hedged. So they have no refinancing obligations until 2024, and their debt is hedged until 2026. So they are relatively mitigated from the rising interest rate environment because of this high hedge interest rate exposure. So with that, we have a buy target price, buy rating on Prime US REIT with a target price of US 88 cents. And like I just like reiterate that we like Prime mainly because of the valuations. They are trading at 17.5% dividend yield, and they're trading at 0.45 times price to book, which is relatively cheap compared to their historical average, where they've been trading about 0.9 to 1 times book value. Yeah, so that's all for me for Prime. I'll hand over the time to Terence.
Yep, thanks, Darren. For Keppel Corporation, the recent announcement is the Keppel shareholders recently approved of in the EGM the divestment of the O&M business to Sembcorp Marine. In the EGM, they also approved the divestment of the Asset Co, which is their legacy rigs, and this divestment of Asset Co or their legacy rigs will be independent of the outcome of the Sembcorp Marine EGM vote. So put in another way, in a worst case scenario where Sembcorp Marine shareholders actually vote the Keppel O&M acquisition down, the divestment of the Asset Co business will still go ahead, which is a positive for Keppel Corp. So right now, like what Paul mentioned earlier on, because of the surge in oil prices and the oil majors capex, you can see that Keppel O&M's order book has really been boosted up to 11.8 billion Sing dollars, and which is a 7 to 8 year high. Driven by all these FPSO contracts, but we see the major re-rating catalyst as the divestment of the O&M business, and Sembcorp Marine has really guided that their EGM is expected to take place later this month, and we believe the successful divestment of their O&M business will lead to a re-rating of Keppel. So we have a buy rating on Keppel, and we have an unchanged target price of $8.95. In our next slide, on BRC Asia. For us, BRC Asia is cheap. It's just trading at 5 times FY23 of FY23 earnings, and BRC Asia is a proxy for the construction sector. Shareholders have a 9.8% dividend yield to WAIT for FY23. And they've for us, BRC have already delivered in terms of earnings. If you look at their latest FY22 results for end year September, financial year September, net profit is increased by 81% on a year-on-year basis, and that gave shareholders a 9.9% dividend yield. So for us, it's very cheap, and you're paid to wait also at 9.8%. So as a proxy for the construction sector recovery, we have a buy rating on BRC Asia with a target price of $2.30. In my last slide on city developments, last counter rather. Yeah, so for us, city developments, there's two main drivers. The first is their resilient property development arm, and the second is the hospitality segment, which we believe will drive earnings for FY23. So for city developments, they have more than 1,800 units in the launch pipeline, and this we believe will elevate the land bank replenishment worry. So what happened in FY22 is that because of the surge in FY21 and FY22 because of the surge in property prices, the land bank prices have also surged in tandem. And so what happened is that the developers are also very cautious in terms of replenishing their land bank. And so for us, we think city developments is actually well placed because they still have a very strong and solid pipeline for FY23. So they don't have to rush to replenish their land bank. In fact, they can be more selective. For FY23, they really lined up a few of the launches. What we do know is that they have two sites at Bukit Batok set for launch, one more site at Jalan Tembusu, and Fuji Xerox development that they also plan to launch, and that we expect to bolster their profit. But having said that, when we look at their current inventory, you can look at Piccadilly Grand all the way to Sengkang Grand Residences, because most of their inventory is already near 85 to 90% sold. So we think that they will still need to replenish their land bank. That's something that they will look at very closely as well. In my last slide on the hospitality segment, we expect the hospitality segment to continue the rebound in FY23. RevPAR for FY22 was already boosted by increased occupancy and rates in Singapore, Europe, and US. So we expect this theme to continue for FY23, driven by the lower COVID restrictions in China. So with that, we have a accumulate rating on city developments with a target price of $8.86. What we want to note here is that this $8.86 target price is actually at a 35% discount to our RNAV. But when we compare our target price to the city developments RNAV, which is about $16, which is $16.80, this is about 50% discount to their RNAV. And the reason for the difference between their RNAV and our RNAV is for their RNAV, they booked in some hospitality profits inside there, which is why their RNAV is slightly higher. But nonetheless, we think our target price reflects the strong revenue earnings driver for FY23. So that's all for me for city developments. I'll hand over the time to Paul.
Yeah, thanks. Next slide. Yeah, so last three slides, I think it's going to be the same companies that we talked about for some time because we still like them. So for me, it's still the Del Monte. I saw a question, why we picked this, because although the liquidity is low, but because we thought for us it's more of a conviction idea, for me at least, because the valuations are cheap and there's also a healthy dividend yield, and we are also the only ones covering it. So what we think of this stock is, just to take a step back, so Del Monte Pacific was mainly in Philippines. Then they acquired the Del Monte Foods, which is essentially the US operations, and that really dragged the profit down. I think they even went to like hardly any profit, 12, 16. So they took them from 2014 to almost 2021 to turn around the business. So this is still, we think at least, is the early stage of the growth, because they were mainly you can think of them like a contract manufacturer of canned food. Most of it was mainly for house brands, for Walmart as well. Then they closed factories and revamped the whole thing and rebuilt back up their brand. So that's why we see this growth, and we see record gross margins for them in the most recent quarter. trends, US is consuming more at home at home than food. The wild card is Philippines. If whether Philippines can rebound economically, consumer demand, then that would be the wild card for growth. Of course, the big overhang is the US $2 billion debt. That won't go away immediately. Most of the debt, actually 1.7 billion, came from the acquisition. So most of it came from the acquisition that's pulling down, not so much the business not generating cash. So it will take time to reduce, but the one catalyst, I do not know the exact timing, is that if they were to list the US operations, which they bought for 1.7 billion roughly, if they manage to get that, then that could allow them to de-gear. So that would be, I mean, at 4 times PE, anything above would be a positive. So that will be catalyst. I'm not sure the timing. So, but we still think that there will be growth as they continue to increase prices. Yeah, I think like 3/4 of their products, at least in the US, is less than $2. So it's I guess one of the most affordable meals out there. Next slide. The next is, I think everyone's familiar with me keep on promoting ComfortDelGro. But so what happened is that the Singapore, so this is the operating profit, excluding rebates, the clean number excluding disposal and so forth. So what you see is that year to date, Singapore has done very well. So Singapore earnings almost tripled. As highlighted earlier, because volumes are, pricing is up. But the one that has been dragging down, even though there has been a reopening, has been UK and Australia. So one of the reasons, especially the third quarter earnings was even lower than 2021, which is during a pandemic year. So what has happened is that because, especially in the UK, a lot of the bus driver, the costs spiked up. I think you can see in the UK, there's a lot of pressure now, a lot of labor strikes and so on. So there's a lot of wage pressure because of inflation. And for them, and all this will be, they can claw all this back because most of their to the CPI. So we estimate they've been given, because of the pandemic and because Comfort runs the taxi operations there, they had to give like almost 15 million of taxi rebates. That means this is out of taken directly. This impact profit indirectly because this is rebates, right? So that has also been the other drag. So, so we are still positive on it, and hopefully for the fourth quarter, hopefully they can raise their dividends more aggressively. That could kind of at least help. Next. Again, it's a small cap in a model company, at least for me. It didn't work out. So it's probably not 100 million, but they keep on buying back shares every day. So one of the reasons why we like it, you just buy the company for the strong economics of the business model. So we think that the bar here, you see 16%, so that's the official ROE. But if you look at the ROE removing cash, it's almost 200%. Of course, the debate is why should you remove the ROE? So they could actually return the 300 million cash and still operate, because they already have 200 million of trade debtors tied up in working capital, which is used for their flexible hiring. So flexible hiring, they have to pay the wages of the employee first. The other half of the business, they have 700 recruiters and they have very high barriers to scale because it's very hard to build up 600 recruiters in 16 countries. So we still may have a buy for this. Next slide. Yep, so sorry, I think I was cut off a little bit earlier. Next slide. So in terms of conclusion, so we think we are in this kind of mini Goldilocks macro environment for 2023, which means not too hot, not too cold. Basically, inflation is slowing down, and then economic growth is soft. But of course, when economic growth is soft, it's going to be very hard for stocks to rally that strongly, unless you're in China, because now there's reopening, so you're going to have a huge growth there. Any recession in the US, we think will be shallow, because the definition of recession, at least if you look at the way the US calculates the NBER, you need a very weak employment. Eventually, this will happen, but we don't see this, at least even for the next 6 months, because of the huge vacancies. And then there is no major deleveraging event, not like in global financial crisis. No, you had like Lehman and so forth, but here it's been narrowed down to only the cryptocurrencies. And like we mentioned, the high nominal GDP and cash flows can still support the economy. Singapore economy is probably one of the best shape ever. I think we mentioned earlier, like wages, especially the domestic economy. When with China reopening, you will give a further boost to a lot of the listed companies. Not to mention tourism. Of course, tourism in Singapore is 5 percentage points of GDP. Sectors we favor is banks, consumer. You'll see a bit of difference between Darren's more neutral, but mine is mainly we overweight based on what we put in the model portfolio. So banks, consumer, which is mainly the multi and so forth. Yeah. So thanks everyone. I think we can move on to Q&A. Yeah.
Maybe I'll start the Q&A first. I've got one or two questions, I think. Okay, I have one question that I think is together with the REITs one. So I think I'll let Darren take the first half, but later I'll just do the second half. It says, likewise, has the price for banking sector peaked, hence time to switch out of banks back to the REITs? So we still believe that there is a growth for the banking sector. I mean, if you look at what they're guiding as well as what we are forecasting, we are expecting that the NIM growth would continue into the first and up to the second quarter of this year. So it would still continue to grow, and this will definitely add positively to their net interest income as well as their bottom line. So one thing that will make it grow further would be the recovery of their fee income. So however, I think the banking sector has still has some room to go. I'll let Darren take the first half of this question later. I have one more question regarding the China reopening. Let me find it. Okay, found it. So the question is, how would China reopening affect existing loan percentage and profitability on the Singapore banks? So I think it's quite broad based on how the China reopening would positively affect the Singapore banks and as well as actually the overall economy. So I think the first one would be increased trade. So as the economy recovers and the businesses start to begin to reopen, so it's expected that there will be an increase in trade between Singapore and China. And this could of course lead to an increase in demand for the banking services, such as maybe trade finance, foreign exchange, and even cash management. And secondly, the increased tourism, I think as Paul has mentioned. So with the reopening, there would be an increase in tourism, and this would lead to an increase in demand for banking services, such as travel, money, credit card usage, as well as foreign exchange again. And the third one would be increase in investment. So with the reopening, it's possible that there will be an increase in interest in investment opportunities in Singapore from the Chinese investors. And now that they can more easily come to Singapore, this would be easier for them to invest instead of having be restricted and maybe just do over online, which is, I mean, I guess to the investors, it's not as personal. So this will lead to an increase in their wealth management, investment banking, and capital raising. So this would also be positively impact the bank's fee income, which has been on a decline for the past year, like in FY22. And the last one would be just an overall sort of increased economic activity between the two countries, and this will lead to a very broad-based benefit for the banks in Singapore across a range of banking services. So I hope I've answered your question adequately.
And just to add to Glenn's one, it's also because NPL concerns. So you notice that if you remember, UOB got sold down because they have this Shima property. So with this reopening, it will also remove the NPL concerns. I think some of the overhang for a lot of the banks in Singapore was like how worrying was their property exposure in China. And secondly, as you know, DBS and OCBC have Hong Kong operations, and so it'll be interesting to see how the Hong Kong banks have rallied since. I'm not sure. I haven't been watching, but how the Hong Kong banks have rallied from this reopening news. And so if they reopen it, of course, it's going to be good for their Hong Kong operations, especially on the loans growth front and like what Glenn mentioned, that's general economic activity. So those are the other two specific areas. But the NPL was the bigger concern because with China situation, the market was just worried that there will be big NPLs coming up from, especially on the for property development and so on. Okay. But let me just do a very quick one here. Someone mentioned about the strategy and do we have a strategy and stop pick starting at 1 p.m. today? Yes, so that is mainly for Malaysia. So for the next few days, we will have a strategy and stop picks for from our strategies from Malaysia. Then we will have one from Thailand, and there's also one, and of course our US team. So there'll be and also Hong Kong. So for poems, for anyone, not just poems, but we're going to have at least 4 more countries coming up. So do look out for it. Just go to the poems website. So that's why we'll probably end early a bit because I also want to listen to the Malaysian one. Yeah. Yeah, it's pause audio intermittent. Yeah, so sorry for that. Yeah, sometimes I'm not sure. Sometimes the Wi-Fi. Yeah. Yeah, can some take the rest? Yeah.
Yeah, okay, I'll take the couple of questions. Yeah, just now Glenn answered the second part, so I'll answer the first part of this question. Hi, the SG 10-year government bond yield has dropped to about 2.855%. Does it imply tailwinds for the REIT sector since the yield spread has widened? This, I wouldn't say this is a tailwind for the REIT sector, but yes, you're right to say that the yield spread has widened. And this 2.855%, now that it's dropped to that level, it just means that investors will probably start looking at REITs again because this bond yield, this bond is less attractive than before, while the REITs are still, maybe the dividend yields are still trading around flattish. So in that sense, if you compare relatively wise, the REITs are more attractive than this the Singapore government 10-year bond yield. So, but I won't call it like a tailwind. It's just a relative basis more attractive since the yield spread has widened. Yeah, the next question is, hi, you used to prefer to use the 2-year yield as a benchmark yield for yield spread comparison for REITs, but has changed to using 10-year yield now. Yeah, so actually this 2-year yield, I used it for one the FCT report back then. My thought process back then was mainly because back then the interest rates, there wasn't much like certainty as to how high the interest rates would go. So I used a 2-year yield because I would assume that we would invest in this REIT for 2 years, while so it's a 2-year for 2-year yield comparison as compared to the 10-year, which is more of a market industry usage. Industry, most of the time they'll use the 10-year for comparison. But back then, since there's a lot of uncertainty, so I thought the shorter term yield would be a better would be better to use as a comparison because yeah, like I mentioned, you hold the REIT for 2 years versus if you compare with the 10-year, it means like holding the yield the REIT for 10 years. So that is why I used the 2-year back then. Yeah, but probably going forward, I'll just use the market, the industry average, the industry 10-year government yield, which most of the rest of industry uses. Is Manulife REIT valuation fair? What's the share price trend? What share price trend should be? Yeah, for this, right now, Manulife's REIT's valuation, they're trading about 0.4, 0.5 times book. So if you account for the devaluation of their assets, this price book will probably increase to 0.5, 0.6 slightly. Yeah, but if you're just looking at valuations wise, Manulife, it is considered fair as it's still cheap. It's not trading at like $1 for $1. It's trading at still like 50 cents to $1, and they are still paying high dividend yield. So what we would like to see is whether is their dividend yield sustainable and whether they can maintain their dividend yield and maybe the growth. So what's share price trend? Yeah, that one I can't really comment on the share price trend. Yeah, I think that's all for me for now. Hand back to the rest of my team. Thanks.
Yep, thanks. Let me just take on this. Hi, Paul and team. Your views on latest development of Jaffa, will it trend up after Hong Kong listing? Just in case some may not be familiar, so Jaffa listed their dairy business in Hong Kong. Every 5 Jaffa shares, you get one of the Hong Kong new co listing, and so that's roughly about 20 cents if you based on the current share price. So before it got listed, it was Jaffa was trading 535, then now it's 335. So it's actually back to the pre-pandemic. So the market pricing it really exactly to what is the current share price of the new Hong Kong listing. We don't cover Jaffa, but the only thing for Jaffa is because most of their earnings come from the Indonesia. They've now become like a holding company. So I'm not sure how the market is going to re-rate or derate them, because if I want Indonesia, I can just go straight to their Indonesian listed subsidiary, Jaffa Confit. And then if I want the dairy business, I can just go to Hong Kong. Then what is left for Jaffa here is mainly, I think, their Vietnam business, roughly speaking. But I think it can. So what is under pressure for them is mainly the grain. So most of this, they make a lot of money mainly from feed mill. Basically, rather than rearing the chickens, they just buy the feed mill and they supply that like a raw material supplier, and they have not been able to pass it on because the price is high and the chicken price are low. But one thing about Jaffa, if you take note, is that this share price is extremely volatile. If you look at the historical numbers for at least the Jaffa Confit, which is the pure play Indonesia, sometimes you can trade at 3,000 rupiah, sometimes drop to 1,000. Now it's about 1,003. Yeah. So for me, it looks interesting. I think it can go back up because if you take the view that commodity price have maybe peaked and starting to trend down, and chicken price in Indonesia is like it's like riding a roller coaster. You just go up, and then when it's too high, then there'll be a lot of supply, then too low, then there'll be a lot of culling. So Jaffa, I think, is always a very good trading stock. So right now it's at quite a low level. So my own thoughts, I guess. So I think there can be a rebound. I think it looks attractive in the sense it's a trading stock. So, and then you want to trade it when it's low, because eventually chicken price will come back up. This has happened, I don't know, the last 2 decades. If you follow some of these Indonesian Indonesian poultry companies. Yeah, it's just a long answer because we don't really cover, so I don't have the exact numbers. Hi Paul, if US labor is about 55% of PCE core deflator, is the current high inflation in the US due to tight labor market, hence high wages? What are the ways that can bring down wages, lost jobs? I think the PCE core deflator, half of it, I'm not sure if it comes from labor, unless you assume it's services, then it's maybe. I was actually quite curious why the wage growth actually stayed. The wage growth is still growing, but it slowed down. My only thoughts is that is firstly, number one, inflation expectations may not be that high in the US. I know it's a very theoretical thing, but what the Federal Reserve like to look at is inflation expectations. That means if I'm not sure how it really works in reality, but what they believe is that if workers don't think that inflation is going to rise or inflation coming down, then the demand for higher wage won't be that high. I mean, yeah, this is the theory at least. So is the current high inflation due to tight? Yeah, in part it is, but not just that. I think the high inflation right now in the US is a combination of the supply shortage, because demand spiked up during pandemic and there wasn't enough supply. Of course, all prices, but that's coming off, and of course services. So it's a combination of all things, because everything went back up. Yeah. And what are the ways you can bring down wages? I think lost jobs, and of course if inflation expectation isn't that high, and these days there isn't that so-called industrial bargaining or trade unions that you have in the 70s. I mean, this one everybody knows about. These are the things that can bring down wages. Yeah. But for me, it was mainly because the market was so even a slight dip in wage growth, the market can rally. So on Thursday when the CPI is up, if the CPI will, so the risk reward we think is there that the market could rally, because if CPI is just a bit lower than expected, the market could rally. On expectations, the Fed might just raise 25 basis points the next hike. Okay, you want to take the next one, Terence, on BRC?
Yeah, okay, let me no, I don't see the BRC question. Did I miss it?
Oh, okay. Sorry, maybe you said, why is DRC being a top pick of overweight construction sector not included in top 10? Oh, yeah, okay. Let me just answer this. Yeah, I think we in part also there's no real magic to it. For us, we just pick one or two small mid-cap names as well. Then we just it's based on our own selection. I mean, we thought that was a better story compared to BRC, slightly better story compared to BRC. That's the only reason. And we try to keep the mid-cap names to only one, at most two or three. That's it. So the rest all should be large caps in the model, and it's not meant to be an aggressive portfolio. So that's why we don't really change it much. What are the top picks that benefit from utilities and air transport? So yeah, Terence, you want to do that? Yeah. Let me wait for Terence. Let me answer. So why select Del Monte and H1 in your asset when both do not have much liquidity? Yeah, we base it based on stories like we mentioned. If we have higher conviction on these stocks, and I know as you can know, we are not really growth investors. We are very more value bottoms up kind of stock picks. The reason why we don't do a lot of all these cyclical ones, because it's very hard to time. And as an analyst, for us to call, let's say make a call on a cyclical stock, by the time we just worry, by the time we make that call, the stock price might have moved already, and then we probably can call a buy for 3-4 months. Then after that, we're going to quickly downgrade. So that's why we're a bit more wary when it comes to the growth stocks. I mean, rightly or wrongly. Next one, can you provide views on Propnex and Wilmar? We cover Propnex. So we are positive on Propnex because the new launches will give them. So the problem for Propnex, although they managed to maintain profits remarkably, although property volumes or transaction volumes in Singapore was down almost 30-40%, either resale or new launch. So we think with new units coming at almost 11,000 in 2023, new launch versus 4,000, this should keep prices up. So this should help them grow their earnings in 2023. 2022, how they managed to offset it was because they actually focused a lot on resale. So I think Propnex took a lot of market share on resale. So how they focus on resale is also they have a big pool of customer data. So they will know which customers, after their 3 year, after their seller stamp duty expire, then they will try to target those customers if they want to sell and capture some profit. No, because there's a seller stamp duty, right? So they want to after that expires, then they want to try to, or capital gains tax or whatever, then they will have a database. So they will focus a lot on the private resale market. That help them stabilize their earnings. The only thing to also note is maybe with GST coming, there might be a little bit of pullback. They might recognize a bit more commissions, maybe. Also on Wilmar, some views on Wilmar. So it should be positive. The whole reopening in China should be positive because Wilmar's business in the edible oil, so they sell branded edible oil in China, and also, of course, soybean crushing. So they will take all the soybean, they will crush it, and then sell the meal to all the swine, all those who breed swine. The farmers are the swine farmers. So they should benefit from that. Although, of course, technically, like Zane mentioned, it's going to be weak. What's your short-term view on usage of price impact on oil price usage on China aviation? It should be positive for China Aviation because China Aviation has most of the profit, basically almost everything comes from their I forgot. I think it's a Shanghai Pudong Airport international travel. So you can imagine how much business they got when there was a lockdown. So that should benefit China Aviation. Petrobras, I do not know. Yeah, but I guess I'm not very sure. But China Aviation has two parts of the business, which is the Shanghai, the airport, which is their associates, and also they do a lot of oil trading, jet fuel trading. But that is like very there is a lot of revenue, but I don't think the profit is there unless there's a contango in the market. So they only make money when there's a contango and they can keep the oil in storage and then earn some carry from that. Yeah. Okay. I think you can go to the. Oh, okay. Let me do this one last. Why are consumer and REITs favored when interest rates are going up? Yeah, it's not the level. I think for us it's the direction of interest rates. We think the interest rates if it's going to peak soon, and with that we think directionally that will be favorable for consumer. For consumer is because when companies like Thai Beverage or Del Monte raise prices, they hardly bring it down. They never lower price. They only keep raise it. Then if raw material and other costs start to come off, if inflation decline, their margins can actually expand. So actually a falling inflation environment or falling commodities is beneficial. And then for REITs, it's not so much. They are going up, but it's probably the last leg. We're talking about maybe another 50 basis point move in interest rates. And then if that is peaking, and if there are signs that interest rates are coming off, then of course REITs should be favorable for REITs. But again, I think like what Darren mentioned, don't expect the dividends for REITs to grow because there's almost no way, because the interest rates are going to claw back some of this, and also there's hardly anything to buy these days because of there's probably negative carry for any acquisition. Yeah, okay. Zain, you can move on to your technicals.
Okay, just let me share my screen. Okay, so the first one I see is UOB. So UOB after it hit the resistance over here at around the $31.30 area, kind of like holding up in the range for now. So the support is around $30 to about $30.50 over here. So for now, I think it has been like range trading for around a month or so. So I expect that to continue until we get a clear direction of a breakout above this $31.30, where the next level will be the swing high last year around $31.90 to about $32. Then if you do get a breakdown, then I think the key level downwards would be around the $29 level over here, which was a previous resistance. Then the next one is 579, which is Beijing Jingneng Clean Energy. So this stock actually is in a nice uptrend. So previously, what it did a double bottom formation around the $1.45 level, and then it broke out of this key neckline resistance at $1.88. So when we take the height of this range over here is around 43 cents, and project it upwards, we could get a target of around $2.30 over here. And as for the short term wise, it also broke out of this uptrend channel over here. And then we could expect some resistance around this $2.10 level to about $2.20 over here, which was quite a strong support last time. And then $2.30 will be a target based on the technicals over here. And then it will meet some resistance over here as well. So given that last time we consolidated over here a while, we should expect some resistance when price goes up a little bit further into this zone over here around the $2.10 to $2.30 level over here. $9,987. Okay, this one for now looks like currently some form of downtrend taking place. So we have these lower highs in the making and then a downtrend resistance line. After we hit the resistance area here around, okay, I got the wrong counter. Okay, let me chart it again. So for this 9987, Yum China, so actually this is looking actually quite good. Because that we actually broke out this 424 level over here, which was quite a significant neckline resistance. Quite significant neckline resistance over here. We actually tested quite a few times, and then we actually successfully broke out over here in December. Currently, what we are doing is like a range trading over here. So, short-term resistance wise could be around 470, which was a swing high last time. And then if we move up further, it will be around 493, 494 over here. Another swing high and previous support over here. Okay, but midterm wise, still looking pretty good as we successfully broke out this level and we are staying above it. Currently just doing some consolidation for now. Okay, then the next one is Jardine. Okay, Jardine, currently we broke down of this big uptrend channel over in October last year. We are still kept in this downtrend channel for now. So the key resistance for now will be, we saw some selling over here around $28.90 to about $29 level. And then we also broke down this previous support over here at $29.60. So this would be the short-term resistance zone for now. As for support-wise, the lows recently is around $27.70 over here. So some support could come around here, or if we do break this level, then I think that we could reach further downwards to about maybe close to $26 mark over here, which was a swing low in July last year. And then we could hit the support of this downtrend channel over here as well. Yeah, so for now, I will expect some range trading over here, or possibly further pullback to possibly retest this around the $26 support over here. Okay, the next one will be Venture. So for Venture, actually not bad. Long-term wise, midterm wise, after it broke down this uptrend channel over here, right? But there's a possible inverse head and shoulder that's could actually form out. So still waiting for the right shoulder to form over here if this pattern is about if it takes place. Then also we actually broke out this downtrend resistance over here around the $17 level today. So that's a good sign after we found some support over here around the $16.90 level, 1680 to 1690 level, which is the 50% Fibonacci retracement level over here. When we take the highs of 1790 and the low around 1570. So for now, maybe I will expect maybe some further bullish momentum upwards. Then we could expect some resistance around 1750 over here, which is a swing highs over here, and possibly a retest of the uptrend channel last time over here. So 1750 to about 1770 over here, could expect some resistance. The strong resistance will be around 1790, which is the neckline resistance over here. Moving on to the Hong Kong counters, HK Tech. Okay, so this one still trending up nicely in this uptrend channel over here. We also broke above this swing high at around 436 recently. So that's still a good sign for a continuation of the bullish momentum. The next level to look at would be around $4.60 over here, which was a previous swing high over here. So could expect maybe some short-term resistance for it over here. And then the next level upwards will be around the swing high over here around $5. So that could be when we hit $5 around here, if we could match the uptrend channel resistance over here as well. So for now, still looking pretty good in this uptrend. 9618 JD. For JD, currently also in the uptrend channel. Then we hit some short-term resistance found over here after we hit the previous swing high resistance at 254 over here. So maybe some sideways direction for now as we try to break this resistance. Short-term support wise would be this level that we broke out from around 240 over here, this horizontal level. If we manage to break above this resistance over here, I think next level we could look at is around 275. Confirm of this uptrend channel resistance as well as a swing high back over here in June last year. So that's for JD. Then moving on to Tencent. Tencent also we have this uptrend channel line support over trend line support over here, and we actually broke out of this rising wedge pattern over here. And then currently we could be facing some short-term resistance around the 370 mark, which was a previous support back over here that we put down last time. So at this level, we could see maybe we could see some sideways direction for now. Then the next key level to watch out would be around the 400 mark, the psychological level, as well as a previous strong resistance over here last time where we tested multiple times over here. So I expect the key resistance to be this 400 level. And short-term support-wise will be around 330 level, which is this resistance that we overcame over here. So the swing high over here will become a short-term support for Tencent. Okay, then lastly moving to Ping An. So Ping An also trending up nicely with the uptrend. So we actually cleared a few levels, which was this $53 previous swing high level in June last year. Then also just today we also cleared $57, which was a previous support over here that could act as a resistance, but we actually cleared it. So the next level to look at maybe is around $60, which is the last time there was a previous support over here that we broke down off, and then another swing high last time. Then followed by around $64 to $65, this swing high in February last year. And last time we also saw some resistance in August 2021 over here. So these are the levels for Ping An. Then support wise will be this likely be this $53 mark, this horizontal level that we broke out from. Yeah. Then for Wilmar, previously I mentioned there could be a breakdown of a consolidation triangle. So for now, it looks like we tested this around we went to about 420 level today. So currently still seeing some selling for now at this level. So actually we are at this resistance zone over here, quite a strong one last time, around 420 about close to 430 over here, where we had a lot of resistance. Yeah, so we can expect some resistance over here. Then there could be a potential breakdown if this uptrend, this support line over here is broken. Then we could see the two supports over here around 380 to 390 as well as 360 to 370s over here. Then BRC. In BRC Asia, when we look at the long-term chart, right, actually is pretty good. So because it's in quite a nice uptrend channel since 2020 over here. So it's followed well over here. And then the good thing is also that actually we broke out of this 177, 178 swing highs over here. Then we are currently just sort of like ranging over here around with the support around 180. So we could see the range continue or or bullish momentum continue if we break out this 184 level over here. So long-term wise, it's still looking pretty good. It's in a nice steady uptrend over time. Then if you're looking at the channel, resistance wise could be around the near 195 around here. Yeah. So this is for the midterm target over here. Yeah. And city developments. So city developments, very big range pattern taking place. Then recently, some bearishness can be seen in the stock as we broke actually with this range over here, right? We broke down the support over here around the $8 mark, and then currently we are trading around near 770 to 780 level. So I expect the short term wise we could see some further selling to test this prior swing low support that's around 760 to about 770 level over here. Then if you do get lower than that, I think the next level to look at maybe is around 720 to about 730s over here. Shows a previous, we had a swing low over here in October last year. And then it will match in the long-term perspective wise, it will match this uptrend channel support over here as well. So this dates back to about 2020. We have this uptrend channel over here. Okay, see iFast. Okay, iFast has been pretty bullish. So but after the strong move, we kind of consolidated recently in this triangle. So for now, we broke out of this triangle last Thursday at around the $5.90 mark. Currently seeing some resistance at 615, which is this swing high over here. So 615 to 623, this we expect some short-term resistance wise. Then when looking at the further back wise, we are heading to this previous resistance area. So around 640s to close to 660, we expect some strong resistance over here. But the uptrend is still intact as long as this trend line over here is supporting the stock. Yeah, which is still supporting the stock for now. Okay, I'll look for SIA or SETs. Okay. So SIA still is also looking good. So SIA actually broke out of this consolidation wedge over here, and then also this quite a stubborn resistance last time around 540 to around 550 level. This horizontal resistance over here. So actually broke out and then we did a back test over here and then we found support. Today we reached a high of 568 before seeing some selling. So 568 last time was around this. There was this horizontal level last time back in April 2021. So short-term resistance wise could be around this level, but and then the next resistance level could be around 587 over here. Another horizontal level last time. If we do manage to clear this level, 568. Short-term wise, I would expect maybe some price consolidation because first time we tested this resistance over here. But for now, I would think the support over here at 540 to 550 will hold. So probably some consolidation before try to break the resistance again. Since the short-term wise is still in the uptrend, and we actually broke out of this triangle wedge. So could be more upside to come in future. Okay, then looking at sets. So for sets, mostly consolidating for now after we broke out of this triangle over here. So we reached a high of around 305, then we pulled back to test this previous resistance at 270s to about 280. Then we found some support, currently doing some range trading. So for now, I will expect some more further range trading given quite some resistance over here from around 290s to about this level over here around 315 over here. So the resistance over here is range. So maybe some further range trading. But the support over here at around 270 to 280 would probably hold over here. Yeah. Okay, my take on gold. So looking at the gold, looking at perspective wise, look at the gold chart, pretty bullish recently. So then we had this trending, we were trending nicely in this rising wedge pattern over here. And then we actually broke out last Friday. So we are currently at this, we're also above this 1867, 1870 level over here was prior resistance. So if we manage to stay above this level, I think the next one we could look at is that around close to around 1917 over here, previous support that we broke down off. Okay, then if we do some Fibonacci retracement wise, I think 1897 is also another level to get 61.8% level over here. So probably we might be able to hit this level for now. Okay, then Alibaba, Hong Kong. Try to find the counter. It's Alibaba actually still looking good. Nice trend. If we follow this previous inverse head and shoulders pattern over here, right, which was formed around 60 to about $84 over here. Actually, we hit the target over here really, around 106, 107. There was a prior support and resistance over here. But if the price does continue to climb, I think there's a chance that the price could still continue to go up to maybe test a strong resistance area over here. That would be around this zone from around 118 to about 122 over here. So over here you can see like in February last year to about July of last year, every time price has tested this area over here, we found resistance. So this could be the key resistance area for Alibaba. But the uptrend is still looking good. Short-term support wise, I would expect it to maybe be around this level over here, which is around 96 to about $100. So this was a previous resistance that we broke out of, and then prior support that we managed to overcome over here. So this is the range to look out for the support. Okay, then let me talk about Singtel. So Singtel currently in a downtrend channel over here, but still waiting to be quite, for now could be at a sort of a critical juncture, because when we look at this trend line stretching back to the end of 2020, right? Every time we reach this level, there's a bounce over here. We actually fell through it once last year in October. So we are around here again. So let's see whether some support actually does come in at this level over here. If it doesn't, then I would think that you continue the short-term downtrend over here in this downtrend channel and possibly actually retest these swing lows over here, which will be a strong support area. That's around 230 to about 240 level over here. And okay, Xiaomi. Okay, Okay, so Xiaomi still trending up in this nice uptrend channel over here. But we could face some short-term resistance at around this $12.40 level. Given it was a prior support over here that we broke down, and then when we did a retest, was a resistance over here. And then this 1240 level will actually match with as a confluence of this channel resistance over here as well. So some short-term resistance to take note of for Xiaomi. But if we do clear next time, then the next level to look out for will be the horizontal level at around $13.20, which is a previous resistance over here. Then short-term support for Xiaomi probably around the 1150 mark, which was this horizontal level that we broke out of over here. And then prior support last time over here as well. Okay, I'll just hand back my time over to my colleagues for now.
I'll take, there's one bank question. Actually there's two but sorry, let me just, I'm not sure. There's the first one, SG rate, SG Bank FD rate better than REIT. SG Bank's FD rate currently is below 4%. So maybe the rest will be able to answer better on the part. Okay, the other one is regarding UOB and OCBC. The question is, UOB and OCBC has been somewhat stagnant. What is your view 2023? So I think the banks, the outlook for 2023 for all the banks, the local banks, at least the UOB, the OCBC and DBS, is similar. We expect the NIMs and net interest income to continue to increase quite well into the first 2 quarters of the year. And fee income should sort of recover slightly from last year, because last year it was off a very high record year in 2021. Hence, there was such a sharp decline in 2022. So fee income should be able to recover slightly going into 2023. And I think for OCBC mainly, why is it our preferred pick is also because of its quite high CASA ratio comparable to DBS at 56. DBS is 60%, OCBC is 56%, as well as its high CET1 ratio of 14.4%, which is the highest amongst the local banks. So that means that there is potential for higher dividends from OCBC. Yeah, hope I've answered your question. I'll hand it to the rest of my colleagues. Thanks.
Yeah, I'll take it from here. Thanks, Glenn. Sorry, because I think there's some issues with my connection today, so I'm not picking up all the questions. But I think my colleague Glenn actually sent us out the questions, so I'll just refer to the one that he sent. Thanks, Glenn. Any outlook for SIA and SETS? So we don't have any coverage on SIA, but for SETS, I think our thesis is consistent with most of the other theses, which is that we believe that SETS will continue to benefit from the loosening of COVID restrictions from by China. The overhang on SETS now is the EGM that is supposed to take place 2 weeks later, about approximately 2 weeks later, where SETS shareholders will actually have to vote on the acquisition of Worldwide Flight Services, and then they need to do the rights to assuming the deal goes through, then they need to do the rights issue on that, and so we think that any re-rating for SETS will only come after the commencement of the rights and after there's certainty over the rights issue. So that could drag out, but SETS has guided that they expect the completion to be first quarter of 2023. So any re-rating will likely come after first quarter of 2023, which is also the inflection year that we expect, because beyond first quarter we expect them to be profitable. What are the top picks of stocks that benefits from utilities and air transport sector, which Philip is overweight on? Thanks. Yeah, so for the utility sector, we have accumulate rating on Sembcorp Industries. We expect Sembcorp Industries to report stronger profit for this year and to announce a special dividend along with a higher final dividend. So top pick for utilities, Sembcorp Industries. As for air transport sector, that would be sets that we are still working on. Yeah, I think that's all the questions I have now. I'll hand back to the rest of my team.
Darren, you want to talk a bit of historically what's the spread between the REIT dividend yield? If you don't have FD rate, then maybe what is the previous spread? So are we being compensated for the additional yield pickup?
Yeah. Hello. Yep. So the SGFD, the bank rate, like Glenn mentioned, around 4. That's on the high end, but then it's actually around 3 plus. So it's slightly under 4, I think. Yeah. So if you compare, whether it's better than REIT, I can't really say whether it's better or not. It's just your risk tolerance. Because of course, if you invest in the SG Bank fixed deposit, it's risk free. But then for REIT, you have to take into consideration the equity risk premium as well as the volatility of the REIT. And then regarding the spread, right now it's trading at minus 1.6 standard deviation. I think just how during the presentation I gave the chart. So yeah, historically is quite low already, the dividend yield spread. So it's not attractive at all to invest in a REIT over the fixed deposit.
What's the average yield spread usually? Like over bonds or whatever? Yeah. 2-3 percentage points. What's the
Off the top of my head, it's about 3-4. I need to look at the chart again. I can't really remember off the top of my head the average.
So just to get back to the question, so whether FD rate is better or REITs, is whether as an investor you're being compensated for the additional yield for the REIT, which we think in this environment you need to be more than in the past, because in the past you can still grow. So in the past the REITs can grow their DPU stronger, but this time around with the headwind from interest rates, we are a bit, the ability to grow would be weaker. So as an investor, you need to be compensated more compared to the past. So if in the past, like what Darren said, is 2 to 3%, let's say you use 2.5%, then you need at least a REIT to pay you at least 6% to 7% minimum, I think, to compensate you, because we know these REITs are not going to grow as well as they did in the past. So that's a general outlook. We can't really say what is better, because if you know FD, there's no risk, right? But if you want to take the risk, then whether you compensated. So okay. So the next one is your take on gold. I think gold has an opportunity at least this time around, because if interest rates are coming, or most important, the direction. That's not the level. So if interest rates are going to come off, then they could trigger at least a short-term rally for gold. And then it's like a hedge. I mean, if there's any bad events coming, hopefully nothing. But if there's anything that's negative, suddenly there's a big shocker, deflation shock, war or spender conflict, then gold can run. So it's a bit of a hedge for your portfolio too. I'll take the last one. Singtel outlook, please. So Singtel, because some parts of Singtel are doing well, some are not. So it's like half that one, like out of 2 engines, then one is doing well, the other engine is not doing so well. So we think it will grow maybe mid to high single digit kind of growth. So what's going to pull the whole of Singtel is going to be the India operations, Bharti, and of course roaming revenue in Singapore. But what's going to pull it down, we worry, is a bit of the Australia, especially after what has happened in the impact from the cybersecurity breach. Of course, there's some good news in Australia too, because the TPG merger has been merging of assets has been called off. But the other thing that's pulling down Singtel is also their enterprise business. So that is the one that's the big down. So it will still grow, because we still think their associates will be the one that does well, but the enterprise business, which is NCS, will be pulling down the overall results, because they're still going to be like declining growth and all that, because they're going to invest a lot on headcount and so forth. So it's still okay, Singtel. I think it will still be a mid to single digit growth, but it won't unless Bharti really takes off, then which so far there is some signs that they might have raised rates. So not a very strong view we have on Singtel. Okay, then so thanks everyone. I'd like to thank everyone for your time, and like to wish everyone a really a blessed, a prosperous, and more important, a healthy 2023. Thanks everyone for your time. And after this, there's a 1 p.m. Strategy briefing by Malaysia if you're interested. Thank you everybody, and take care. Have a good day ahead.